is we get the recession that the central banks want, asset prices crash, and everybody willingly owns their bonds. The bad outcome is any other scenario where people won't own their bond.
David Dredge, thank you for joining the podcast. You're a very hard man to track down these days, international jet setter. How are the travels? How worried are people? What's the feedback so far?
It was a good trip. Ash knows I just got back from a rare 3-week swing through the U.S. I sort of bracketed a very enjoyable presentation at Jim Grant's 40th anniversary conference in New York at the beginning, and then speaking at the CBOE Risk Management Conference in Austin at the end, and met a few, investor types on my way through town, some endowments, some pension funds, some fund of funds, some wealth managers. So I have a pretty good idea of what's going on. Let's say it's kind of, it's a continuation of what we've been talking about forever, Ash. Is, things have changed. The stability of price stability has sort of broken loose from the 30 years post Greenspan put of faux suppressed volatility, and now they're struggling to put the genie back in the bottle. And that's sort of driving everything, and everyone trying to figure out the ongoing implications of this, sharp reversal in central bank policy, and the implications for the, financial sector. The story I've been telling for, I don't know how long now, Ash, but who's going to own the 40? Who's going to own all the bonds? Now that the myth that these things are risk-free or risk-reducing in the 60-40 model, that the bonds are a portfolio complement that reduce the risk of the portfolio. Well, it turns out that was all artificial and driven by a brief time in history central bank reaction function of cutting interest rates every time asset prices fell. And prior to the implementation of that and the targeting of inflation by central banks, that just didn't exist in the world. And we could see in the last couple of years, it doesn't exist now. And so that's really kind of the theme that everyone's talking about. I'd probably argue there's way too much emphasis on what rising interest rates might do to people's equity holdings or real estate holdings, and less emphasis than there should be on what it's doing to the bond markets in the world, and what we've been talking about for yonks, that the biggest uncapitalized risk in the system is all the, what I call sharp world, the badly regulated accounting practices of the financial industry that have been incentivized to own all of these government bonds over the last 20, 30 years of this expansion of fiscal dominance and financial repression under these rules that say it's somewhere between riskless if you're a bank to risk reducing if you're a pension fund or a wealth manager. And the fact that there's no capital supporting losses in these things, you get the inevitable of Silicon Valley banks and Signature Bank and Credit Suisse and liability-driven investment schemes in the UK that need bailing out. And so that's kind of the theme that people are talking about. As usual, as you're probably well aware, the US crowd is very myopic on the US, so they were all, interested to hear my thoughts and inputs on Japan and Europe and China and stuff. So, but very much the same.
I've known you for a little while, and I believe you've been in financial markets for a little while too. Yeah. You've been through a few crises, and I've been through a few crises with you. Do you think this is the most broad-based risk setting we've seen in a long time on a global basis? We've got geopolitical, we've got political, we've got fiscal, we've got monetary risks all building. Is this, as Neil Howes would call it, is it the fourth turning?
Yeah, I think so. I mean, you've got the sort of culmination, and as you know, I've been asking central bankers the same question. Originally started with a conversation here in Singapore with then New York Fed President Bill Dudley in 2010, as regards the longer term implications of things like zero interest rates and quantitative easing. I kept asking the same question. I still ask, really, Bank of Japan's the last one left to bug about it. What if it works? What if, after multi-decade of zero interest rates, ever lower interest rates, artificially imposed negative correlation between fixed income and equities, quantitative easing, constant bringing forward of demand through subsidized credit to fuel growth, what if at the end of all of it, you get the inflation you claim to be targeting, dreaming of? Because surely you'll, at the end of all of it, you're going to have the most fragile system imaginable against rising interest rates at exactly the time you need rising interest rates to battle the inflation genie that's now out of the bottle. And I think, because the whole world, it was one thing when Japan was the only one doing it 30 years ago. And then it was another thing, in the Asian crisis when the massive negative real rates borrowing subsidy of pegging currencies to a much lower yielding currency, and then dot-com bubble, and then GFC, and then European credit crisis, and on and on. But eventually you got the entire globe, the whole world, at zero interest rate, or negative, in the case of Europe and Japan and Switzerland and etc. And QE and peak central bank balance sheet usage, peak manipulation of the term structure of interest rates, peak, and through it all, sort of sneaky, right? Sort of sneaky. And really, I think, conspiracy theory Dave, the point of the whole thing, every major government in the world sneaking through 100% of debt to GDP. Something that, even in our young days, you didn't think was possible.
History would, tell us that over 100, 120% of GDP, it's a problem, right?
Doesn't work.
The other question I get asked a lot too is, if you run your own, your household or family wealth and you've got bonds that are down 50%, as an example, you mark to market that down 50%. Clearly, on the institutional side, we're not seeing that. How does that come to fruition? I think we're starting to see it reflected in some of the equity valuations that we see publicly traded. But that causes issues and tightens credit in the whole system if they've got these unrealized losses. And I think you've as you allude to so succinctly and simply that it's a credit crisis, but it's also a refinancing crisis, as people have borrowed at, call it 2%, and now that's 8%. By definition, that is going to tighten credit, surely.
Well, I threw it out on the stage at Jim Grant's conference, trying to liven up the crowd. I said that, in the new world, the new regime, post zero interest rates, post QE, post forever accommodation from global central banks, the refinancing of debt has become a Hunger Games competition. And there's an ever scarcer supply of the liquidity to roll over existing debt and fund new debt. And in this Hunger Games competition, Janet Yellen, my old econ professor, is playing the role of Katniss. She's unbeatable, right? She will crowd out every other borrower in the system to get what she needs. And you can see it happening right before your eyes, right? She's out there. She's just saying, well, I need another 2 trillion. Go for it. Go for it. And if if she's going to pay 5% as of yesterday on 10-year treasuries, what's the other guy got to pay? Whether that other guy is a competing G7 sovereign, Italy, France, or that other guy's an EM sovereign, or that other guy, to your point, is a corporate credit. Why am I going to take credit risk if I can get U.S. Treasuries at 5? So this competition is spinning, and all the while in the background is the bigger problem. The big problem, as always, isn't the borrower. The big problem is the previous lender. The borrower can always default and figure out how to deal with the implications of that. The guy who's short the default option is the lender. And in the case of all these government bonds, and not just U.S. Treasuries, most prevalently U.S. Treasuries, but government bonds everywhere in the world, have all been parked on these regulated balance sheets with no capital to absorb the losses because they're zero risk-weighted assets in banks, or because of IAS 19 and pension fund accounting schemes. Levering your gilts reduces the capital required for your portfolio. It's madness. Solvency II, an insurance company, says holding long duration sovereign bonds is less capital required than holding cash, less risky than cash. And so they've forced all of this debt into these regulated entities that, as you say, aren't marking it up to market. They have these massive unrealized losses sitting on their books, which is why, again, I dubbed it at the grants conference. I dubbed what's going on. I've claimed naming rights. So somebody else got to name global financial crisis and dot-com bubble and et cetera. I'm claiming naming rights for this one. I'm dubbing it the Great Stop Loss.
Let's just try and simplify that. So because of the leverage and the non-mark-to-marking, legislation or policy has said levered treasury bills, bonds globally are less risky than holding cash. As a result, offsetting, risk asset in a portfolio. But there's not enough collateral or money or credit in the system to actually pay that.
Yeah. Right.
If called.
Yeah. Once you go through 100% of debt to GDP, everybody basically doesn't have enough money to pay off their debt. Right. If the interest rate is roughly the same as growth, you can never catch up. And so you've got this sort of reflexivity, and this is really what's happening in markets right now. You've got this reflexivity of this pressure on the whole, the holders of the existing stock of debt. So the banks, pension, insurance, wealth managers that all got duped into buying this because it was deemed riskless, and they're allowed to account for it as riskless. They are allowed, Silicon Valley Bank management allowed to pay themselves bonuses for the accrued interest on their portfolio of non-mark-to-market hold-to-maturity bonds in 2022, even as the bank is insolvent because they've got a 15% loss on a $100 billion portfolio of hold-to-maturity bonds and only $13 billion of capital protecting their other $150 billion of RWA assets, as they're insolvent. And so because the system has been incentivized to hold this debt, pay themselves bonuses for annual accrued interest, or for the short term of this on something that had really zero chance of long-term real compounded gains for the end capital holders, the poor pensioner or depositors or insurance product holders or whatever. And so as this grind puts the pressure on these guys to, again, they can, and Bank of America, whatever, their $130 billion of unrealized losses in their hold to maturity portfolio. 130 billion. That's like bigger than their loss in 08. And it's just sitting there on the books as though it's not a problem. Now, at some point, they can say, well, we're just going to sit till it matures and we get our money back, and we just happen to accrue interest at 1.5% for the next 10 years in a 6% interest rate environment. Or they can clean their book up and start doing new business at 6%. So there's an enormous amount of pressure on these guys, banks, insurance, pension funds, to clean the clogged arteries of all this stale stuff that's sitting on their book, not marked to market, not capitalized, to clean it up and go out and take advantage, because, it's a good 6% interest rate world. It's a good place to be a bank, good place to be a pension fund manager, good place to be an insurance company. So the guy who, bit the bullet a year ago, took the hit, he's loving life right now. Right. The other guy who's still accumulating unrealized losses and not writing any new business, can't do new loans. He's got, huge loan demand because interest rates are up and business is booming and blah, blah, blah. Janet's issuing fresh debt at 6%, 5.5%, and they're sitting on stuff that's still yielding 1%. There's a huge pressure out there to tidy this up. But as they tidy it up and interest rates go up, the government, who has to refinance eventually, has to pay higher. They're running bigger deficits than they've ever run in peacetime, non-recession period ever. So there's this reflexivity, right? Every time rates goes up, there's pressure for the great stop loss to liquidate more of their duration holdings, which makes rates go up, which makes the deficit bigger, which makes the issuance higher. Supply and demand gets more and more imbalanced. And this is the classic, this is what a black swan is. This is what tail risk is. It's the endogenous risk. It's the lack of capital in the system to support something that everybody thought was not risk. Right? The old Mark Twain. It's what you think for sure that's going to get you in trouble, right? It was the zero risk-weighted assets of senior tranches of super senior subprime CDOs that was the problem. They were riskless. So you levered them infinitely, and the slightest change in their value wiped out capital. Well, that's happening in spades all over the world, because all over the world, every bank is holding their domestic sovereign, and all OECD sovereign debt is a zero risk weighted asset. And they've lost a lot of money on something that they held no capital against.
So two things spring to mind, and you've talked about this for the 20 years we've known each other. So it's gone from the household balance sheet, corporate balance sheet, banks balance sheet, and now we're seeing it on the sovereign balance sheet globally. The two questions. Obviously, the VAR model needs to be adjusted in this environment. It worked for a while. There's debates around whether it really worked. So obviously at a how to analyze risk needs to be somewhat thought about in a potential different way. This collateral or credit gap, which is growing by the day, my thoughts are there's only one type of entity that can try and fix that, and that's the sovereigns, which then becomes into this spiral. Again, is that they really need to, the only way to plug the gap is to issue more debt. And then you go from 100 to 110, 120, 150% of GDP. I think as James Lavish always talks about, it's this debt spiral, right? But is there a way to solve it? Probably more radical thinkers, some sort of debt jubilee, really. Can you plug the gap, number one? Number two, if you can't, what do you do?
Yeah, I've been saying, in fact, I'll write it in my soon to be written October monthly update. I suggest all of your listeners go check out our website at convex-strategies.com. We post a monthly letter up there, and the history of that letter is about as good a description of what has happened as you're going to read anywhere, plus a few good insights in what risk really is. And so to your point about things like value at risk and stuff, I wrote what I think is a very good note, one of my favorites, back in March of this year, titled Probability versus Possibility. And value at risk and the financial mathematics of our times that drive the regulatory structure of the financial system and the investment strategies in modern portfolio theory and efficient market hypothesis are all based on probability. Risk is based on possibilities. And risk is about endogeneity, not about the probability of an exogenous shock. Lightning can strike barren ground all day long and it won't cause any fire. But if it strikes a bunch of clogged trees and brush after a multi-year bad forest management, you'll get a fire that spreads throughout the whole forest and burn the whole thing down. And again, decades of QE and zero interest rates have created that environment. In the financial system, that connectivity of dry brush is leverage. And leverage creates the scarcity of loss-absorbing capital. I say all the time, if nobody had a mortgage on their house and house prices fell, wouldn't matter. But because everybody's mortgaged to the hilt when house prices fall, it's a big problem because it puts the whole banking system at risk, which puts the whole saving system at risk, which puts the whole sovereign system at risk.
I suppose the other thing too, and I think this happens at most levels, is austerity, right? Or belt tightening per se. It just doesn't seem, whether it's because we have short political cycles or it just doesn't seem to be, practiced anywhere, right? It's a political thing. If you tighten the belt, I'm not going to get voted in, or I'm going to miss the next house or whatever.
It is the right answer in the end, right? The only cure to the drunkenness is the hangover, right? It's the only way to get over it is to stop drinking and feel the pain, right? It'd be austere. I've been saying a lot lately, and like I said, I'll probably write about it. The way I see things right now, and really, as I went around the U.S., the narrative, and you see this every day. I mean, everything you read on Bloomberg and the Wall Street Journal and the FT that you see on CNBC and all the official mouthpieces of the system is telling you, and has been telling you for quite some time, that the recession's just around the corner. Right, the recession is nigh. The narrative about the pain the economy's feeling of all this stuff, and the recession's just around the corner. I mean, Bank of England's been forecasting a recession the next quarter since Q4 2021. and yet, it's not here yet. And so I keep saying, listen, the good outcome currently is we get the recession that the central banks want, asset prices crash, and everybody willingly owns their bonds. The bad outcome is any other scenario where people won't own their bonds, because without satisfying this debt rollover need of all these countries that have blown through 100% of debt to GDP, you're in this cycle where, well, are we going to be austere? No. So we're going to issue more debt because we have to prop up the economy. And the only person who will buy that debt is the central bank, but nobody wants to own the bonds because they've lost control of inflation. And if they buy more bonds, nobody wants to own the bonds because they've lost control of inflation. You get in this cycle that's really hard to stop and is really this sort of doom loop in an end of times, fourth turning, to use Neil's term, world where we've created so much fragility that you can't stop the loop, right? The fire starts and you can't stop it spreading because all of your tools just make it worse. And
so just back onto something you said there, I find interesting. So the realization of a recession, however long that takes, admitting there is a recession, actually letting markets correct prices, asset prices correct. Obviously, bonds rally. That's the best way to get through this, rather than the colloquial kicking the can down the road. Bonds rally, financing becomes cheaper. But do we have the structural correction to behavior, or is this as nature does, cycles of recession or ups and downs clean out the dead brush on the ground, essentially?
Yeah. And so I think, and I think they think, getting to the recession is the whole point of 50 and 75 basis point interest rate hikes. It was to get the curve so inverted that it brought the recession forward as fast as possible. By keeping the curve inverted and the perception that the recession was nigh, people held onto the back end, right? The 10-year yields were almost 150 basis points below 2-year yields. People were happy to hold them because they thought the recession was just around the corner. And then sure enough, these guys start playing with pausing, right? Listen, nobody knows for sure, but I said if they pause, the back end's going to sell off because people say they haven't slayed the inflation beast. I don't want to own these bonds. Now everybody else says, oh, the bonds sold off because they paused, but said they were going to hold them higher for longer. Well, if that's what they thought, then the curve would stay inverted. People are selling the bonds because they don't think they've slayed the beast. And then this becomes self-fulfilling. It's very reflexive right now.
Yeah, and then it's almost like they're snookered, right? Because they've got their own profit and loss statements are showing interest expense like we've never seen before as a percentage of GDP. And that doesn't seem like it's going anywhere away. I think the last article, or maybe you were commenting about it, was that interest expense is higher than the defense now in the United States, right? And where's that money going to come from? And there's only one avenue, which is issuing more debt, which is more supply, and so less demand.
Yeah. The doom loop, right? We're in this reflexive loop now. It's very hard to get out of. And a lot of my very good friends, my sort of inner circles of brain sharing thinkers, everybody's just absolutely adamant that you got to buy bonds here because the recession, because rates are way too high. And now you can imagine, they're all getting destroyed because they've had this view since Silicon Valley Bank. And it's hurting a lot. But you hear every day, well, Bill Ackman this week taking profit on his short because now's not the time to be short bonds anymore. Maybe, I'll just go back to my view. I'm not a macro guy. I'm just a risk manager, right? Your viewers may not know. I'm just a long volatility tail risk guy. I just agnostically buy cheap vol. Once I buy enough cheap vol, it gives me a pretty good idea of where the risk is, because the guy selling me that vol at the wrong price is doing it because his rules and regulations don't require him to capitalize the potential tail risk of that. And so you get enough of that, you can say, oh, as you've heard me say for the last 9 months. Bear steepening is going to hurt a lot. And everybody said, well, bear steepening's never happened, Dave. I said, well, it may not happen, but if it does happen, it's going to hurt a lot. And sure enough, it happens. Now everybody wants to ask me why I thought there was going to be a bear steepening. I said, I didn't say there was going to be bear steepening. I said it was going to hurt. And now you're feeling the pain. You know it hurts. You know, as I always say, risk isn't what you think is going to happen. Risk is what hurts if it happens. Most people would do a far better job of risk management if, as opposed to evaluating external macro data, they just focused on their own balance sheet and understood what they were exposed to, and then extrapolate that to the system. You know, every bank in the world knew that a change in the correlation of mortgages and a downgrading of the AAA rating of their super senior tranches, subprime CDOs would wipe them out. And if they thought about every other bank had the same position they had, they probably had a good idea of what the systemic risk in the system was. Obviously, today, that's uncapitalized holdings of sovereign debt, and it all around the world, every bank, etc. Same story. We, no matter how we talk about it, Ash, we're going to end back in the same loop. You have this same problem, and how they solve it, I don't know. But my assumption is that they solve it the same way they've solved it. They do QE. They just try to keep kicking the can down the road. But that means you probably don't slay this inflation genie that's gotten out of the bottle in the long run, and that we end up with this extended period. And you've seen my pictures and my writings of the scattergram of the Bank of England data on inflation average and volatility going back to the 1200s. The anomaly in all of the history is the dot, the 20-year block from 1997 to 2016 that has the lowest volatility ever in history of the CPI index in the UK. And now we've broken out of that, and that instability of price stability is feeding through to volatility of nominal GDP, volatility of interest rates, volatility of asset prices, sort of structural economic volatility. And what you're getting, and what you've been getting and you'll continue to get, is more divergence from the mean of the expected outcome. And I always say, in terms of risk management, in terms of compounding capital through time, it's the divergences that matter, not the expected. Right? It's the fundamental flaw of modern portfolio theory is that it's trying to maximize expected return. A better strategy is something that maximizes actual return. Think about that.
Yeah, it's it's all positive news. It's interesting. Yeah, I don't know how it gets solved. I mean, I think the other thing is clearly, again, on sovereign P&Ls, the capital gains tax, or tax on gains, is disappearing pretty quickly as well. So the income side of is deteriorating quickly. So on all that positive news, the asset class wise, like, how do you think about it? There's obviously 3 or 4 asset classes that could take global amounts of money. Obviously bonds have had a very a tough year. Commercial real estate's probably another one. What are equities holding up relatively well now? Is that a weight of money coming out of bonds into equities? Is it as simple as that? Are we, my background now, it's obviously not in the league in the sense of AUM of some of these asset markets, but we've got big global names starting to look or talk about the crypto space and Bitcoin in particular to start off with. Are we seeing, we need a new answer? We need a Convex strategies. We need help, right? We need other assets because of that credit gap and, the difficulties funding that gap.
Well, again, you know my philosophy. Construct your portfolio so that it's convex, so that it's resilient to the divergences from the mean of the expectation. A portfolio whose relative performance improves as variance of outcomes expands. not one who's targeted at the mean, that's focused on the frequency of returns, not the scale of returns. And that's the kind of modern portfolio theory, that it deteriorates in its relative performance as you diverge from the mean of the expectation. And as we all know, in the real world, nobody gets the mean. The mean is literally just the average of divergences. And
so, again, I'm a very simple person, Dave, as you know. So in layman's terms, that would mean don't buy insurance for the leaky tap. Buy insurance for your house getting burnt or a flood, right? So it's don't buy insurance for the $20 item. Buy insurance for the,
correct,
and affect your portfolio.
Correct. Because the outcomes in the center, the 2 standard deviation outcomes, are almost insignificant in the terminal compounding path. It's the outcomes outside of that. It's the big winners and the big losers that drive the compounding path. Now, in the financial fiduciary world, they ignore that, right? They're the proverbial race car that's driving around without brakes, using a historical look back of what the worst curve they saw was, and saying, well, driving at 60%, so we'll put 40% in bonds and we'll drive at 60% average speed, and that'll be about right. And it is about right 96% of the time. But all of the time that it matters, the other 2% fastest part and the 2% most dangerous part is the only part that matters. So to your value at risk thing, value at risk is always wrong, but inside 2 standard deviation, it looks close enough. The problem is the only time it matters is outside 2 standard deviations. And that's where every bank goes bankrupt and you need to bail out the system. That's where the big winners exist. That's where Google exists and Apple exists, and some innovation, some service product provision to humanity that nobody's thought of before. And so the key to managing your investment portfolio isn't trying to figure out what you think is going to happen. It's trying to be resilient to what you don't know is going to happen, and to create investment strategies and structures that benefit on the top side, that have positive convexity at the top side, things that participate in those winners, Bitcoin yesterday, right? And have protection on the downside. The insurance, not the insurance that covers your monthly health checkup, but the insurance that covers your chemotherapy if you need it. The stuff that you can't recover from, the stuff that knocks you out of the race. So you put good brakes on your car so you can drive faster. You don't put good brakes on your car and still drive at the average targeted speed. The whole point is to get rid of that junk that only performs in the easy part of the track, and load your machine up with the stuff that benefits in the most important parts of the track, sharpest corners, fastest straightaways, right? And so own things that have unbounded exponential potential upside, and own things that have highly asymmetric, negatively correlating protection on the downside. Go out and find, and as you know, this is what we do. Like I said, I have no view on anything. I'm not bearish. I'm not bullish. I have no view. But if somebody will sell me something that's priced like it could never happen, I'll buy it. Right? Because the biggest relative change in price is that jump from it could never happen to it could happen. That's a much bigger relative change than going from it could happen to it probably happens, which is bigger than going from it probably happens to it did happen. It's that first jump is where the really big asymmetric potential is. And either if you have the ability to find that yourself, or go out, obviously I'm biased, go out and hire a manager that's a professional at it, because managing, playing goalkeeper is a lot different than goal scoring. It's a different challenge, a different mindset for anybody who grew up playing football, right?
Yeah, I mean, I think both our strategies, ours in the crypto and yours in the risk mitigation, I think they're coming at this from different angles, but solving the same problem, right? They are
Correct.
System hedges. And I think the key for institutions like ours is we're trying to find cheap, mispriced assets. Correct. That in the case of a breakdown, however you want to frame that, and whatever is, we're not trying to pick the trigger. The trigger is, or the catalyst the catalyst is impossible to predict, right?
Correct.
And there's so much going on in the world. It could come from anywhere. Like, it's too hard to predict, which I think you're suggesting is what traditional models are trying to pick.
Yeah.
How would you know? And then, going and finding mispriced assets globally to essentially go long convexity. If it really does go very negative out there, which we're not wishing on anyone.
No.
But as you say, you don't buy your insurance for your house for the leaky tap, right? You buy it if something drastic happens.
And you hope you never need it, right? I hope my clients never need the protection that we've constructed in for their portfolio. But they'll be glad they have it if they do need it, right? I mean, you hope your restaurant doesn't burn down, but if it does burn down, you'll be glad you had fire insurance, right?
Yeah.
But meanwhile, your job is to go out and run the best restaurant that you can and be aggressive in running it and find the most sophisticated food and the greatest atmosphere and you know best pricing margin you can possibly create and and ride it to the moon. And so you're exactly right.
So you're getting the best charcoal stove in to make the food taste the greatest, to get your customers to produce revenue. You're not doing that because you're worried about the place burning down.
Yeah, correct. Imagine how cautiously and anxiously you would drive around Sydney if you didn't have any brakes on your car. You'd be the biggest wimpy, sissy driver imaginable. Put good brakes on your car, off you go. Right? The whole point of good risk mitigation is to allow you to take more risk. Right?
Yeah.
I say all the time, you don't hedge risk you don't want. You hedge risk you do want. If you don't want the risk, get out of it. Sell it. Right?
Yeah, and I think the other stuff you've always talked about is trying to time that.
No.
Is almost impossible. Maybe it's the Buffett analogy. You've definitely got similar analogies. Timing that. I mean, how many times do people get out of the low and, you're not going to do it. When really the insurance for the fire is the way to do that, right? You are hedged for a, crypto exposure, Bitcoin exposure. If the system's breaking, it doesn't mean you want to exit everything.
You don't pull off the racetrack mid-race and say, hey, put some brakes on the car. Put the brakes on the car at the start of the race and drive as aggressively as you can, knowing you can jam the brakes on if you need them. You create, and again, this is the whole solution to compounding. And the biggest flaw in the whole financial system is nobody's come up with a effective metric, and more importantly, an incentive structure for geometric compounding through time. Right? We've eliminated the path through time, which should be the ultimate objective of what everyone in the fiduciary world does, and said we're just going to look at it as a slice of time in 200 parallel universes and say that the two percentile wings are unlikely to happen. But in each of our own individual path through time, I guarantee we all get our own 2 percentile wings. It's a certainty, right? So I think I told you this story. I was meeting with a super sovereign wealth fund and showing, talking about risk and stuff. And he says, yeah, but what's the probability of that? And I said, 100%. And he said, huh? I said, well, what's your time horizon? Because, his time horizon is a month. My time horizon is, the 40-year cycle of the retirement saving he's managing. In that 40-year cycle, I guarantee you'll get a 1 percentile outcome. It may not be next month.
Yeah, that's very interesting. Yeah, because people's pensions, I mean, globally call them, I have no idea, but 40 years, 50 years, whatever. Yeah. That's really what they care about. It's not about the 1 month performance, is it?
That's the problem. That there's a disconnect between, the end capital owner and his desire for terminal capital to retire on, and the fiduciary who's working on an annual incentive structure. So the fiduciary is happy to target, in my race car analogy, he's optimizing average lap speed and assuming that the cars, as far as he's concerned, all start over equal the next lap. But what really matters to the capital owner is the separation between cars, is the compounding path. He wants to optimize from the end of 40 laps back And if you do it that way and you capture over those 40 laps all of the unforeseen sharp corners and unforeseen fast opportunities, you'll say buy the straddle. But the fiduciary who's optimizing to average lap speed 1 lap at a time without concept of the risk of crash if there was an unexpected turn and the foregone benefit of a good straightaway, he's saying, well, just sell the straddle. Let's just target average lap speed, and within 96 percentile, we'll be in there. And he's foregoing all of the compounding opportunity of the fast part and taking all the risk. And so I say this all the time about many of our hedge fund friends that we've known in the absolute return seeking world. None of them are taking enough risk to achieve the returns that they've promised to their investors. And all of them are taking a lot more risk than the risk they're reporting to their investors, because they're underjuiced for the top side and they're using a probabilistic measure, value at risk, misrepresenting the potential downside. Thus the concave return dynamic that all traditional multi-asset investment strategies have. There you go.
Interesting. Now, I'm going to dig a little bit deeper into the crypto space. You're referenced in one of my old colleagues' notes fairly regularly. I can't remember the acronym, but is it Mr. D or something like that, who is, I
think I'm
fairly successful.
OG Vol guy.
Yeah, OG Vol guy. So if we walk down that plank a little bit, have you, with your expertise of volatility, have you looked at the cryptocurrency volatility space?
Yeah, we look at it a lot, and some of your old colleagues that I'm close friends with who have gotten into that business check in with me regularly. And now for what I do, it's relatively speaking to the opportunity set that we have access to, it's not cheap. And it's simple. The reason it's not cheap is that most of the participants in that world, in the volatility world of crypto, have skin in the game. It's their money. And so they're not willing to sell a ridiculously cheap, ridiculously convex structure in some form relative to what happens in the food chain of structured product machinery through the banking system, where they can hit F9 and their value at risk and their historical stress scenario says they can sell that 1 delta option.
So just digging for people that may not be aware, so volatility, David looks at every asset class globally. The supply of volatility, which he's alluding to, comes from certain type of products, right? And I think, right, David, sitting in Singapore and knows everyone in Asia is, well, globally, but Asia particularly is, I don't want to steal your thunder, Dave, but there is a lot of supply of volatility in traditional markets, and that's where you've been picking up. Do you think that comes into the crypto space on a second question?
Yeah, I mean, I tell everybody, all my crypto friends, I'm very interested, and I'll be much more interested when the regulated financial institutions get involved. So I love that BlackRock's getting involved. I'll love even more when Goldman Sachs is getting involved. I'll love, when the regulated moral hazard space gets involved and you have massive, massive players gambling with other people's money, they'll do things that people won't do gambling with their own money. And then that structured product machinery, which, again, some of your old friends and colleagues are trying to gin up in that space, will start to build and build and build. And when that starts flowing through regulated entities, the scale of the risk will get much bigger. And so our mutual friend who founded one of the exchanges, he explained to me early on that the risk in the way his was constructed, unlike, say, the ones that went out of business, they were providing leverage. His margin is just automated. When the guy who took the position hits his margin, the position gets cut and the margin gets liquidated. Now, that means that on my side is the guy who wants to win massively big convex asymmetric payouts. I can't make very much money because I basically can only make the amount of money the margin is put up. Now, if my counterparty is Citibank, I can make the entire U.S. tax base, because when they lose money, they get bailed out by the government. So there's a much bigger potential payout, and they're willing to do things, that are much higher Convex because, I mean, to be fair, it's not their money. And the system is supposedly protected by regulatory constraints, but those regulatory constraints rely on this faux financial mathematics that everybody won Nobel Prizes for. And so that's the world we're focused in now. But as and when, and I mean, it's great news, right? BlackRock's getting in, and Fidelity's getting in, and Nomura's getting in, and Goldman's getting in, and eventually, one of those guys will call me and say, "Hey, would you look at this, Dave?" Well, now I'll be much more interested because then I can start digging into, the scale of the supply that's coming in from people who aren't capitalizing, accounting, managing the risk appropriately, and we can create interesting asymmetries. Now, I would love to own calls on Bitcoin if ever the chance presented itself at the right price.
If the volatility got cheap enough, I presume.
Yeah.
As a historian or a scholar of volatility, which is a very rare skill set, my guess is new asset classes, high vol, come in, and that vol just slowly creeps lower over time until, and the last bit is, this type of corporate type supply, essentially.
Yeah.
Trying to increase yield, but with a relatively high yield and waiting for regulations. And I think in financial services and these types of products, that is helpful, right? We are very for regulation across the space, but with a high vol becomes a high yield for the end user, and that becomes attractive.
Yeah. As I always say, a market, a system won't get truly risky until it gets regulated. Then it'll start to get truly risky. Right? A free market isn't that risky because it's just a whole bunch of independent players making and losing money off of each other. It's when the regulators, the regulatory system comes in and tells everyone it will make sure it's safe, then people start taking risk that the system's on the other side of. And that's where risk gets systemic and interesting from the perspective of how we try to protect, the big disaster, right? We're not trying to protect, a plus or minus 10% move in some asset class. We're trying to protect against, serious capital impairment and systemic risk systems and stuff. And so I think I'm friends with a number of crypto guys and we do business with them. And I think it's a great convex asset class. I don't understand it, but it's an alternative, and there's clearly an appetite for an alternative. Clearly, the experiment, the inevitable experiment in fiat currency, certainly looks like it's doomed to failure. Now that could be decades and decades away, but they're mismanaging it so much. Again, if back when I was in business school in the late 80s, my econ professor, Janet Yellen, would have said no rational developed country would go beyond 100% of debt to GDP. And now she's out there slagging debt out at 130% of debt to GDP, telling us all it's not a problem.
Yeah. It's pretty amazing. I mean, I think there's a couple of things on the crypto side, and hopefully you get involved with it when it's cheap enough. Is that, obviously there's a Bitcoin store of money function, but I think there's also a technology play here, right? Making, transacting money, real world assets getting tokenized on a ledger, to me makes a lot of sense, right? Now that may take time, but I think if you think as a species, we like to make things more efficient. I think blockchain technology makes a lot of sense. The store of value thing will, Bitcoin, I think has got a really fundamental story, but it's also banging up against traditional systems, right? And that takes time to evolve through those periods, and I think that's what we're seeing now. But if you keep on issuing debt, supplying more things, they become less worthy.
Yeah, no, I agree. Bitcoin has the network effect, is the sort of leader, and has created this tradable currency in effect that allows people to move money and move value around in this sort of metaverse. You can see Ether and Solana and stuff like that has a use case. There's an actual use case to it that I think is a compelling story. Still too slow, too cumbersome, too costly. Maybe Solana fixes that, and ETH evolves, etc. But there's something there. It's obviously attracted a huge sum of money. It's continuing to attract institutional money. Governments and regulators, go back and forth whether they're going to participate or they're going to try to kill it. Right now, the U.S. seems, 1 minute they seem obliged to killing it, and the next minute they're letting BlackRock launch an ETF. So just maybe it depends who you are.
Potentially launching an ETF, I think.
Yeah,
and it sounds like you know a bit more than nothing about it.
Yeah, well, like I said, I have a cup of coffee now and again with people who are quite familiar with it. So it's an interesting thing, and it's something that people ask us about a lot in terms of obviously when we're speaking with our clients, a lot of the discussion we have is with how they're taking risk on their driving faster side, and it's obviously one of the things that comes up regularly in the discussion. And it's funny. I think early on, most people thought Bitcoin was a hedge, and it turned out it wasn't a hedge. It was positively correlated to risk in the system, and so it participated in the asset inflation and over participated. So it became a very good complement to the brakes. But it turned out it wasn't brakes because it was positively correlated.
Car, right?
Yeah, it was a faster car. So it was an addition like tech stocks or PE or venture capital. It was something that was juiced to the upside, and then conveniently it was correlated to the downside. So negatively correlating to generic market risk was a good hedge for it. And so it turned out it actually worked quite good in the sort of barbell strategy of things. And now I'll argue as our friend does, who writes the famous blog, as the Fed, the big risk to Bitcoin was a restoration of credibility of fiat, was a restoration of normalized interest rates, and getting away from profligate government spending and debt and QE and etc. And sure enough, when central banks started fighting inflation, Bitcoin didn't do so well. Once they paused in their fight in inflation, Bitcoin's done pretty well. And so Bitcoin behaving that way.
The correlation you talk about. So I totally agree. When it first went up, it was a faster car, sold off, pretty correlated to the, the high, the alpha long duration tech stocks.
Yeah.
Are we seeing a breakdown in that correlation now? And again, I'm not trying to pick the driver because potentially there's a lot of things in the undercurrent. It's hard to know. Is it central banks? Is it geopolitical? EMDM. There's a lot of stuff going on, and we're not here trying to pick the lightning strike.
Yeah. Yeah. Maybe, right? And again, our friend would say the anticipation of the sort of inevitability of going back to QE or using even more fiscal stimulus to cushion the assumed inevitable coming recession makes crypto more attractive, right? That we're going back to that profligacy and the alternative to fiat currency. The attempt to normalize interest rates and restore credibility is over. It's going to fail. They're going to go back to being non-credible. And so the alternative to fiat is, again, significantly attractive, even as other duration assets are getting dinged because they're getting sold because they also believe inflation's coming back. And so maybe, I don't know, but again, Mr. Crypto writes that way and talks about it a lot, and is a big believer that that the inevitability of a resumption of QE is a ginormous win for Bitcoin and crypto in general.
Fascinating, Dave. I could speak to you for hours, and I have in the past. Thank you for your time. We will we'll put all your contact details in the show notes. And if anyone wants to contact Dave, please do. It's a remarkable conversation. and one of the great people out there. Thank you so much.
That's great to see you, mate. Thanks.
Thanks, Dave. Cheers.
Cheers.